Should we do an intro and then you can jump into
We'll just weave this in later. So Grok 4, I'm a Grok user, been a Grok user for probably maybe a year, probably more like 6 months though. And, for the last 6 months, been more kind of like, I guess a heavier user of it because when I have Gemini too, I have the Gemini option, right? And I'll go back and forth. I don't use the ChatGPT one. I know that's supposed to be pretty good. I've kind of tapped myself out on how many of these things I'm going to pay for. But I'll typically, there was a time where I would do one, a query in each, or I'm trying to do this Grok 4, I'm trying to do this Gemini, what do you think? And it was noticeably better in terms of the answers I would get out of Grok 4 were much more, kind of to the point. They're more accurate, less kind of quote unquote hallucinations than you would see out of Gemini. And then I would look at the sources and actually liked the sources that Grok 4 this was 3, that Grok would go to, it would access Twitter and get kind of the real-time info. It would go to websites that I would typically have gone to on my own. And when I looked at Google, it looked a lot more like a Google paid search in terms of the sources that it would cite. So it was they were financial websites if I asked a financial question, but they were not the websites that I would typically go to. And so that's where I started to kind of pivot more to Grok, as just my general kind of go-to AI. I think the language, the terminology, the vernacular that I would use was more aligned with what I'm used to seeing too. So maybe there's just a familiarity bias there. But Grok 4, I think, is interesting because now when you put a query in, I think what I see, and it kind of gives you that little bit of narrative of, hey, this is what I'm doing as you ask me the question. It almost seems like it's taking that question, and Gemini may also be doing this, right? Because I don't use it as much anymore, but it's taking that question, and it's almost like it's asking several different kind of personalities of AI bots behind the scenes. How would you approach this question, giving them all of that, giving all of them that kind of, task or that request, and then comparing answers, and then kind of synthesizing the best of all of those. Maybe it's 4 or 5 different answers, synthesizing that back to you in terms of here's kind of a little bit more than just kind of the conventional knowledge, right? Here's the answer that it comes back with. So it's been pretty good. It is slower though, right? I don't feel like you have that give me the just quick and dirty answer anymore. So every request that you put in there, it does take, probably 30 seconds to a minute to get a response. So if you're comparing that to the old, get on Google something and you get a result, it's definitely a lot slower than that. So, there's always trade-offs. But I've been happy with it so far.
Do you
and I'm excited about the future, right? This is a year.
Where it's going.
1 year of how much ground we've covered in 1 year is just phenomenal. So where it's going is just is super exciting.
Well, you pay for it, right? So my question is the difference between the baseline free version and the one that you pay for, why pay for it? What exactly do you need to be using it for to warrant the fee?
I think it's more FOMO.
Yeah.
I feel like I am in an industry that is an information-driven industry. It's a knowledge industry, and I need to have the best of the best, right? It's, it's probably like paying for an underbody coating on your car when you buy it because I don't want to get rust, even though I live in the South. I actually don't know if it's better than the non-paid version, but I don't pay for the most expensive one. Apparently, there's a super heavy Grok now that's $300 a month. I only pay for the mid-tier, which at some point I was top tier. Now I'm just downgraded to mid-tier, but I think I get some satisfaction out of knowing that I'm a little bit smarter and a little bit faster than everybody else in the world.
Do you think that moving forward,
that's just how I normally wake up on a regular basis. So.
Do you think moving forward, when we look at business expenses, that most businesses will have AI as one of their line items each and every year moving forward?
So that's a great question. I kind of view it as there are going to be businesses that are going to be more kind of, I wouldn't say the blank check, but very much ahead of the curve in terms of we want our employees to have that as a resource. And there's going to be others that realize, this is like a cell phone. Every employee's going to have one anyway.
Yeah.
Why would we go ahead and pay for that thing that they're already going to pay for on their own? And they'll kind of just, play a little bit of a staring contest and realize, okay, well, most of our employees, they're paying for Netflix. They're just going to, their AI of choice is just going to be part of a Netflix bill, right? They're all going to have a subscription. So I think you're going to have, all ends or, all different areas of the spectrum there. For a firm like ours, we're typically trying to be ahead of the curve, right? So no, we have not gone to our employees and given the green light saying, hey, we'll reimburse you for any, OpenAI or Gemini expenses that you may have, but we have made significant capital investments in projects where we are partnering with technology firms to bring AI tools to our employees and to our clients. That's a little bit of a different game, right? It's not, it's not a, hey, we're going to pay $30 for everybody's chatbot. It's, we're going to try to think about, some core competencies that we have internally. And then we're going to try to figure out how do we use AI to make those competencies better, faster, cheaper, smarter. So that's a different way to approach it. And I think when it comes to like large corporations, that's probably what you'll see more of. Is you'll see capital projects either buying the equipment to do the work in-house, or contracting a really good consultant to bring expertise in-house. Likely that's easier to kind of think about versus just paying for people's personal expenses just because they might become better employees.
So you mentioned that AI has really just catapulted in terms of its capabilities within very short order. My question for you is, when it comes to these types of projects, how far away do you think we are from, okay, here's all the data and it pumps out an answer? How far away are we from it taking the answer and then actually executing action instead of having to bring in a human to do it?
What do you mean by action?
So let's say I feed it a bunch of data. Like here at Avidian, we feed it data about how we operate, about our functions, and some numbers where the expenses are. And it identifies...
Like a financial plan?
Yeah, kind of like a financial plan, yeah,
Okay.
where it kind of identifies where there are expenses that are unnecessary, let's just say hypothetically. And it says, hey, you should actually fire this employee because you have one too many employees in this arena.
Yeah.
At what point are we going to be able to hand the reins over and let AI make decisions like that? Because I've seen new organizations sprout up, like DAOs, like decentralized autonomous organizations, where they're using smart contracts where if certain qualifiers are met, action is automatically triggered and the company or the organization does it.
Yeah.
I'm curious how much power or authority will be delegated to AI in the future to effectuate decisions, kind of like smart contracts in DAOs.
Yeah, I mean, I think that's going to vary considerably organization by organization, right?
Yeah.
If you want to look at how Avidian, like our core values, one of them is transparency, one of them is accountability. And so when we are very much accountable to our clients. And so I think for a firm like ours, we're going to take a really measured approach when it comes to replacing the human in relation to like actual transactions that take place or plans that are put into motion. When it comes to speeding up workflows, I think that's where we might be a little bit more on the forefront. But we are extremely accountable to our clients, right? So any risk of call it an action based on a hallucinatory result from an AI system, that's not something that we'd be comfortable with. So we'll probably be a little bit more measured in that approach. But I think there are organizations that are going to be, a little bit more on the forefront, where your organization is based a ton more on scale, a ton more on numbers, just numbers of people coming through the door, and less on kind of the curated quality of the product. So we're trying to strike a balance because we know we have to stay competitive. The other thing with Avidian is that we do really value the employees here and the people here. We know that our intellectual property or intellectual capital comes in and out of the elevator every single day. And so, where some organizations might be looking to just cut headcount and replace it with, an automation or, quote unquote robotic processes, we're really looking to kind of upscale our people and bring those expertise in house so that the folks that are here that have kind of put in the hard yards over the past 5 to 10 years, they benefit from that as well, right? So we're an employee-owned organization. We kind of believe in approaching it from that perspective. And if we think about it on the other side, well, if there are people that are refusing to improve and learn, well, that's a different issue, right? But I think you have that issue regardless if you have AI or if you're moving from an office that used to not have electricity and now has electricity, right? I mean, any kind of technological advancement, you want your employees to be on board with it because you want them to get better and benefit from the enhancements as well.
So maybe it'll help optimize, boost efficiency, but not replace at the current juncture.
Optimize and boost. Those are good words. I like that. Yeah.
Right.
We're going to optimize. We're going to boost.
We're going to optimize.
We're lifting people up. We're building people up.
I think it was on the show Silicon Valley, but two of the characters, one of them was messaging the other and thought he was fostering a really cool new blossoming friendship, and it turned out that the guy he wanted to talk to didn't really want to talk to him, and he built an AI to talk to him for him.
I remember that. Yeah, it's a good episode.
And he had no idea he was talking to. I'm waiting for the day where I start texting you and getting back some responses, and I think we're fostering a friendship, but it's an AI the whole time.
That day will never come, Robert. I'll never pawn you off to a machine.
It's a good cover. Good cover.
Well, everyone, if you've enjoyed this little lead-in, welcome back to the Ask Avidian podcast. If you haven't guessed, Robert Palmer is joining me, our head of financial planning. I'm Jake Borbidge, still here as our chief investment officer. We've got a couple things on the agenda today. It's been a pretty exciting and eventful last couple weeks. We don't talk a lot about politics, but when there are political changes, we do talk about the impacts of those changes and whether we need to do anything or whether our clients need to do anything to just either be prepared or to react to those changes, because the investment landscape, the financial landscape is something that continually changes. We're grateful for that because that keeps us employed. But we also need to make sure that we're not asleep at the wheel, which is definitely not the case. If you are an Avidian client, likely you've already received some communication from our firm when it comes to OBBBA and how that may impact your portfolio, your planning for your financial planning for the next few years. But that's going to be the main focus of our conversation today. Is really, there's a lot of different things that went into OBBBA. I don't know how many pages it is. I'm guessing it's more than 10, but probably less than 20,000, but probably somewhere closer to that 20,000 range. It's a lot of stuff, right? It's going to be a long bill. It's actually long enough that it's called a bill act, right? Which
That's
I
right.
thought it was either a bill or an act, but this is both. It's a
This
bill
is
act.
both.
It's a bill act.
It's a bill act.
And so Bill Ackman probably appreciates that naming. Anyway, if we get into the bill, so I know, Robert, you've been looking at this. You've been talking to some of our clients and also some of our prospects in terms of what they need to know about this bill. So if you had to say, what are the most important things, what's in it for me kind of stuff, what should our clients be hearing and what should they be doing in their portfolios?
Yeah, great question. There have been a lot of things that have been made permanent that were up for grabs originally, and other things that have just been extended out till the year 2028. So I think it's important to understand what those are. It's also really important to understand the difference between itemizers and people that use the standard deduction. So the standard deduction was expanded under the TCJA and has now been made permanent under the OBBBA bill, or act, I should say. I always get confused. Bill, act. I'll just call it OBBBA.
OBBBA bill.
OBBBA bill.
It's just OBBBA.
It's just OBBBA.
If you add bill and act, then you've redundantized.
It's too redundant.
Yeah,
you're right.
The name is already redundant. Don't extra redundanticize this thing.
So the standard deduction has stayed large, and that really benefits most people because most people do not itemize. And on top of that, even if you don't itemize, they've introduced new charitable deductions for standard deduction users. So normally, if you wanted to donate to charity, you had to itemize if you wanted a deduction for it. That is not the case anymore. Now, an individual can deduct up to $1,000, and a married couple can deduct up to $2,000 while still taking the standard deduction. So that's also an added benefit. People are able to give to good causes without having to itemize and still receive a tax
benefit.
benefit.
Awesome. Yeah, I love
it is
that.
awesome.
I love that.
That being said, on the topic of charitable donations, they did make it slightly more challenging to get a deduction for itemizers. And I think it's because they were worried about how much of a tax write-off they were getting for their donation. So individual taxpayers will have a 0.5% floor, which means that if you look at the person's AGI and they make a charitable deduction of, let's say, $10,000, they're going to see what amount is above 0.5% of the AGI, and that's what's going to be your deduction. The 0.5% of the AGI will not be your deduction. So that is just something that you will not be able to write off. So let's use real numbers to make it simple. Say you have you're making $1 million a year, okay, and you want to donate $100,000. So that's roughly 10% of your income. 0.5% of your income would be what? $5,000? $500? No, $5,000, right? Because 1% is 10,000, and half of that would be 5,000. So
Okay.
that would be half of 1%. So the first $5,000 you donate would not be deductible, but the other $95,000 would be deductible.
Okay.
Yep, and that's what you would use for the write-off. So that makes it a little more challenging
Yep.
For the layperson who's itemizing.
They have to keep track of that, right? Or that's going to be in the tax form.
It's going to be in the tax. It actually lowers the amount that they're probably used to deducting through charitable donations. So that's just something to keep an eye out for.
Okay.
So again, you got larger tax brackets, which is good for everybody, a higher standard deduction, which is good, now a non-itemized charitable deduction that can be used to help support good causes. The annual exclusion, the amount you can gift that's not subject to tax, that has not been changed either. And I would also say that from an estate tax perspective, the threshold has gone up, not down. Everyone was worried that it was going to sunset.
I'm hearing a lot about that. Congress is good at doing nothing, right? I've heard that quote somewhere a lot over the last couple of years. So Congress did something when it comes to estate tax.
It did
right?
do something.
But they didn't blow the doors off.
No.
Okay,
There's
so it
still
went
a
from what
threshold.
to what?
It basically went from 13.99 to 15 million.
Okay.
Per individual, so married couples can protect up to 30 million, individuals 15 million.
Is that set, or does it does it up adjust over time?
There will be an inflation adjustment after the year of 26, so
Okay.
it will adjust with inflation moving forward.
So what does that mean for estate plans that, like, we've done estate plans for clients, over the past few years? Do they all need to be torn up and restarted, or is it just a minor difference?
No, I would say what it does is it extends the clock. So even though this has been made permanent, there's no sunset for it. At the end of the day, we have seen through this bill and others that have passed through Congress that this can change pretty quick. The sunset was within a year. If nothing was brought up, it would have been cut in half. And similarly, this exemption can always be taken away.
So this is not a set in stone. There's no sunset, but it could be repealed.
It could be repealed.
Okay.
It could be taken out. So what I would say is that the estate plans that have been created serve as fantastic foundations. It does not by any means mean that you do not do estate planning. If anything, it means the ground is prime for it, because now you have a higher exemption. You're able to utilize that to do more proactive planning today and hedge against there ever being a repeal against it in the first place.
Yeah.
So I think it's actually an opportunity with now a longer clock, so you have more time to work with, more flexibility, and get more creative.
It's nice to have a little bit more time to work. Right, you can be
Oh, yeah.
more thoughtful, but you still want to do that thing. You don't want to kick the can down the road till 3-4 years from now, right? Things may be different.
That's right.
So what about SALT?
SALT deductions. So what wound up happening prior to the TCJA, SALT deductions were a really big thing. A lot of people were writing a lot of things off when they were itemizing through what's called state and local tax deductions. That's where the acronym SALT comes from.
So this is back in early 2000s, right? 2000,
That's right.
2010, 2015, right?
Yeah, the TCJA capped that. And the reason for that is because it expanded the standard deduction, and they knew that they were going to be cutting back on tax revenue.
Yep.
And so they basically said, hey, we want to limit the amount of write-offs from these other arenas to make sure we don't go into a larger deficit.
Right.
So
So winners and losers back then were like the coasts were losers and the middle of the country were the winners.
anyone
right?
with high state and local taxes were
Yep.
a loser in this,
Yep.
for sure.
Okay.
And so what the new OBBBA just did was basically extend the cap from, I think it was 10,000 originally, to now up to 40,000. So it increased the amount that you could write off to state and local deductions.
Yep. Okay.
The importance of that is that there are some clever non-grantor trust strategies you can use to stack SALT deductions with property that people are now looking and exploring. This was much more popular when there wasn't a cap on SALT deductions, because obviously you could stack it infinitely or exponentially. There is a place for it. It is relevant for those living in metropolitan areas that may benefit from having a slightly higher deduction through state and local taxes.
Yeah.
But again, with that cap, it does limit the economic benefit. I think people are still going to be torn between the standard deduction and itemizing for the most part. I think most people will still choose the standard deduction.
Yeah. Okay. Now, because you have a little bit of a higher limit, but it's still capped. If you were kind of between, right, like if it was 10 and went into 40, if you were at the $15,000 deduction level with your past deductions, you just weren't looking at things like, I don't know, maybe sales tax, right? Does that count under state and local tax? Mm-hmm. So should people that were kind of hitting that cap and exceeding it a little bit before, do they need to maybe, track purchases? Like, what do they need to do to make sure that they at least get to that $40,000 mark, or is it just more likely that they'll do the standard deduction?
I would say when you're taking the standard deduction, you're getting close to around $30,000 as a write-off as a married couple.
Okay.
And around $15,000 for an individual. So anytime you're looking to capitalize more than that, individuals more so than married couples could really capitalize on SALT because they can secure a higher deduction than they could through the standard deduction. But it kind of depends on the assets you own. So a lot of times this could be local property taxes and state taxes. And so if you're looking at like New York City or perhaps LA or San Francisco, any highly taxed metropolitan area where your ongoing tax bill is going to remain higher above whatever standard deduction you qualify for, then it would make sense to itemize.
Yeah.
Then the only thing you got to worry about is AMT, the
Okay.
alternative minimum tax.
Yeah. So let's get in. I think these are probably the big winners. are small businesses, right? So there's a lot
Oh,
of
yeah.
businesses and business tax incentives. What do you know about that? I mean, we have a lot of small business owners as clients, and we talk to a lot of them on a regular basis. We also invest in a lot of small businesses on the private equity side. So what do those particular entities have coming towards them?
Yeah, so there was a small business tax deduction, QBI, I believe that's 199A. That has now been made permanent, which is fantastic. I think it's a 20% above the line write-off for small businesses that are taking income or passing through income. That's huge.
Okay.
Definitely a big boon and helps the affordability of new employees and things like that, and also profitability. That's a big one. There's also
Depreciation, right?
179 and 168. So you're able to.
You don't need to know the numbers. I mean, that's flexing on our audience. But
well, to be honest with you, I remember the numbers easier than I do the titles because that's what I have to cite.
So depreciation is back, right? It was phasing out over the last few years.
That's right.
Now a farmer can go out and buy a tractor and write it off, immediately, right? 100% of that purchase.
Yeah. So it's important to distinguish between Section 179 write-offs and Section 168 write-offs. So 168 is basically for bonus depreciation. That's something where if you're looking to create a net operating loss and carry it forward, you really want to be using that. 168, which is bonus depreciation. 179 is not really about capitalizing an asset. It's really about just expensing it all in year one. So the reason 179 is important is that state laws can vary with how bonus depreciation is calculated, but 179 is basically universally accepted across the board. So it gives business owners some flexibility to determine what they need to write off in year one versus what they should capitalize and then depreciate over time.
Okay, very exciting stuff.
Oh, yeah.
Anything else in there about small businesses?
Yes, I believe they extended out Section 1202 qualified small business stock. Originally, I think, I'm going off memory here, it was a $10 million exclusion on the gain of the sale of your company. So if you had a C Corp, you held it for 5 years, and it was a qualified C Corp, you were able to sell it and exclude up to $10 million of gains and not have to pay any tax on it. I believe that's been expanded to be 15 million now.
Okay. Wow.
Which is really cool. And there are some really cool strategies that I won't get into here where you can stack this QSBS, it's called, and get multiple exclusions in order to basically avoid taxation on those gains.
Okay.
I had to be careful with my words there.
So last thing, we got to talk about the children, right?
The
Trump
children.
accounts. The kids, the Trump accounts. This is exciting, but is it really something that meaningfully expands child's ability to save and build wealth over time?
Yeah, it's a great question because if you're looking at things like UTMAs and 529s, you might be asking yourself, well, why should I invest in the Trump account versus these other vehicles? And to be honest with you, it's not an easy decision. So let's first talk about what Trump accounts are. Trump accounts open up starting this year. So basically anyone that was born this year is going to get a Trump account, although it won't come into being probably until next year. The government will donate $1,000 into that account, and that'll be a one-time deposit. So the government will not contribute anything more into that account.
It's not taxable.
It's non-taxable.
Awesome.
Any contributions that are made subsequent to the government is for the most part going to be after-tax monies, meaning your annual exclusion of $19,000 that you're able to gift every year to whoever you want. You can use some of that to gift into a Trump account. Trump account has a contribution limit of $5,000, and you can use your exclusion to help fund that Trump account. The Trump account will grow tax deferred. It'll have a wide investment selection of low-cost ETFs to choose from, possibly some mutual funds as well. And because of that tax deferment on the gains and on just the capital in the account, the idea is that it's going to compound quicker than it would in an ordinary brokerage. That's kind of the idea.
Yep. Tax deferred is good. So how do you use can you use those funds like a normal account, or is there a penalty for taking them out before you're 18? Like, how does that work?
Yeah, there is a penalty if you take it out before 18. What I will say is that
but not before age 72, right? So it's not like an IRA.
No, and this is where there's some questions as to how the account will actually work, because what was in the bill versus the act is different. And
I thought it was a bill act.
Well, okay, with the bill act, we'll just call the final act.
Okay.
There are things that were in the proposed bill that are different than the final act.
The BBB versus the OBBBA.
That's right. There you go. Yeah, that's right. So, for example, I don't want to confuse the audience with what the bill said versus the act. So I'll just
let's
focus on what passed.
What went into law.
So this is really meant to help people afford homes and start a business. That's really what this is. And the idea is that you put money
for the kids. Yeah, not us.
It's always for the kids.
Not us. It's for the kids.
They're the future.
Okay.
And the idea is that when you pull the assets out, and you use it for a qualified expense, it'll just give them a better start. And originally, and this is where there's some confusion, is that it was age 31 and the account had to be distributed in its entirety at that time. I'm not seeing that in the final act. I'm also not seeing if qualified expenses, when you pull out the funds, if they'll be taxed at long-term capital gains or ordinary income. That's also not in the final act. I can't find language around it. So I am confused as well with regards to how these funds are taxed when they're pulled out for qualified expenses.
Okay.
Because if you look at the text, it says it's basically governed by the same provisions that govern IRAs, which would lead one to conclude it's taxed at ordinary income. But I'm not 100% sure.
Okay, so definitely some positives there. Not 100% clear on the details or the operations or where you're actually going to go to open these accounts. But I think the fact that they're on the way, it's exciting, right?
It's exciting. And I would say there is one benefit that is new, that is unique to Trump accounts. And that is that companies can make contributions pre-tax as a write-off. So companies can make contributions to their employees' kids' Trump accounts up to $2,500 a year, which counts.
I've seen some companies already come out and say, hey, we're going to fully fund this thing.
Really?
We're going to hit the limit. Yeah.
That's awesome. Yeah. Because to be honest with you, the individual receives no tax write-off, but businesses do. So this would be a great avenue for businesses to support their employees through supporting their kids.
Yeah, and I think it's one of those things where it's like, you get a couple dominoes to fall, and then this just becomes part of the traditional benefits package that most large public companies provide.
Yep.
It does make it, a little bit harder for less profitable companies to stay competitive, right? If there's another avenue to provide, tax enhanced benefits to your employees.
Sure.
But I think, you'll see a lot of adoption. Once the details are more clear, I think you'll see a lot of adoption of this.
Well, I think it also depends on the small business owner you're talking to.
Yeah.
Because to be honest with you, if I started a small business and I'm employing my children, and there's grandkids, or I'm employing other people and, I might be related to them, this is a great way to have a deduction for the business and put it into a tax advantage account for somebody else who I want to give the money to anyways.
Yeah. No, that's a really good point. Last thing, also for the kids, but, I have my kids are teenagers, right? Mm-hmm. And so this piece that I saw come out was particularly relevant. A deduction on auto loan interest.
Oh, yeah.
I have a 15-year-old who, by the time this goes into effect, will be asking daddy for a car. Daddy would typically say, well, used car is good enough for you, little, honey. But now that the interest is deductible only on brand new car purchases and only on brand new car purchases made in the USA.
That's right.
I'm assuming that if she's reading the news and if she's using Grok to really kind of help negotiate with her parents, she's going to say, Daddy, you should be buying me an F-150. The tax deductible interest is going to be something that you can write off. It's made in the USA, super safe car, all those things, right? So is that something that is going to be a meaningful change in people's buying behavior? Is the used car market going to be that much harder to, kind of sell are we going to see valuation gaps created between new cars and used cars because of that tax deductibility? Yeah,
that's a great question. If I had to guess, one of two things are going to happen with regards to the price of a new car. Either the price of the new car is just going to go up to reflect the present value of the car itself and the tax savings that the owner's now going to have, or it's going to be used just to subsidize the existing elevated cost of cars as it is. Because with all the new tariffs and everything like that, they want to motivate people to buy domestic, which will be good for GDP. And they also want to make sure it's affordable. And a lot of cars are not really affordable for the average person. I think a lot of people will take advantage of the write-offs. But also, to be fair, a lot of our clients are likely not going to be able to take care of this or take advantage of this, I should say, because they're going to be phased out. There's an income cap on it. There's an income threshold.
Yeah. Okay. Well, that's too bad. But I'm assuming most teenagers are not going to hit that income threshold.
That's the sweet spot.
Right?
Use your kids to get the write-off.
Use your kids. It's just a good example, a good answer for most things in this life. Right?
That's right.
Okay. So I think we got one more thing that we want to touch on, which is the usage. We talked about it a little bit the last time we got together, but it's private investments, private equity, private credit, making its way into 401k plans, which I think, that has also been, I would not say necessarily signed into law. It's the avenue for that has been opened up. The logistics have still not been ironed out, but it's an interesting development. I've read a couple articles on this just over the past couple weeks, and the interesting thing is really to kind of you go past the article and you see what people are saying, right, and how people are receiving this potential news, and the receipt of the news has been very all over the place. I saw one comment I saw today was I would sooner visit Chernobyl than invest in a private equity fund in my 401k plan. And another one right after that was, well, it's really great to have greater investment choice, greater flexibility, and greater decision-making power on behalf of the plan participants, really. So I think the way this news is being received all over the place in terms of plan participants. In terms of plan sponsors, I think, it's probably, again, a little bit all over the place. Private investments in a 401k plan bring a lot of logistical challenges. I know the people in the middle and back office at the plan sponsors are probably, really kind of scrambling now to figure out how do we manage cash flows if somebody elects a plan that only has monthly or quarterly subscriptions. Elects a fund that only has monthly or quarterly subscriptions. How do they trade into that? How do they trade out of it? What does it mean when we start, we have 10 mutual funds that price daily and we have one private fund that prices weekly or monthly? Is that going to be something they can support? So obviously a lot of things left to be determined in the details. But from a pure investments perspective, obviously we tend to think more choice is better than less choice. If you have the ability to diversify across 10 asset classes or 10 particular investment choices, it's better than 2 or 3. So the potential to do well, I think, increases, but also the risk increases, right? So you have a new asset class, probably a new fund manager or sponsor. We typically call them sponsors in the private equity world that you need to learn about and evaluate. You have a new liquidity consideration, right? And so somebody that has just started the job, with a large company that has a 401k plan, they may have 25 years to invest. Maybe that liquidity is not something that they're too worried about. Somebody that has been with a company, has a lot of accumulated wealth and getting ready for retirement, they have a completely different liquidity situation. They may be coming out of that plan in a fairly short order. So a lot of different things that are coming to market, coming to these plans, they're going to have to wrangle through. Robert, if we had this ability today, and we had to guide our clients in the usage of their 401k plans, what would be kind of the best advice you can give them? Do they buy the credit fund? Do they buy the private equity fund? Or do they say, okay, well, we're going to keep it plain and simple in the 401k plan, and we're going to leave those more complicated decisions to somebody else?
Part of me just wanted to say yes and walk away, but if I figured you might need a more robust answer, so I'll do it like this. I think that you highlighted the primary concerns, which is time horizon. I think that if someone sits down and reviews their portfolio and says, okay, I got 5, 10, 15, or 20 years before I retire, before I'll need to liquidate some of these investments and create an income strategy and ultimately change the fundamental nature of how the portfolio operates, the longer the time horizon, the more it's going to change the decision, because the more you can sit on the investment. And private equity tends to be a long-term decision when you invest in it. Yep. That being said, for long-term investors, I think it's a great addition to the portfolio. To use your tagline, diversification is the only free lunch. It adds an asset class.
I'm glad you gave that one to me and not Mr. Buffett.
Oh, of course, I threw it at you, man. It's going to be your tagline. And I believe that added exposure to that different asset class is just going to give a smoother trajectory overall to the portfolio. That's what I believe over the long term. What I would say is that I have questions around the offering for private equity within the 401k. Like, what are going to be the regulations around it? Does it have to be a fund that gives a really diversified access point to private equity as a whole? Or is it going to be more specified sectors, like private equity that focuses on like startup tech companies or real estate, venture capital?
Yeah, I mean, if I had to speculate, and I've been involved in some of these discussions trying to get this over the fence a number of years ago with plan sponsors, and it's always been there's always been hurdles to get over, right? So now that the regulatory side of it is easing up a little bit, I think it actually will happen. But I do expect there, both from a influential perspective and from a practicality perspective, I do expect the offerings, at least the first ones that come on to these plans, to be, we'll call it the most plain vanilla, highly diversified private equity or private credit options that you can find. And I think that for a couple reasons. One, from an influence perspective, the people with the loudest voices are going to be the ones with the deepest pockets, the largest private equity firms, and they're going to be able to offer a very diversified, kind of broad access platform. A smaller shop would not be able to do that, right? But they also wouldn't have the deeper pockets. They wouldn't be able to influence the decision makers. And so I think, from an influence perspective, I expect legislation to be influenced to try to incorporate rules that will require you to have a pretty broad set of diversification across, whether it's sectors, maybe even asset classes, vintage years, all those sorts of things, which are not easy to do. And so it really kind of narrows the field from that perspective. And then just from an investments perspective, if it's your first private investment, and this is kind of the same advice we give our own clients. If this is the first time that you've invested in something that's not liquid, that you may not be able to get your money back out of right away, make it something a little bit safer, a little bit more diversified. Sometimes there's some cost breaks when you go with something a little bit more diversified as well. And so I think there's two influential, forces, both converging to make the first investments that come on, the things that are a little bit more kind of plain vanilla, broad-based private equity, broad-based private credit, and likely real estate, which real estate might actually be the first one because they've been in the discussion trying to get this into plans for a number of years, probably even a decade or so or longer. So that would be my speculation.
There's probably a good argument for real estate too, because it's asset backed, right? It's not as speculative as like a startup tech or venture capital.
Yeah, very, very tangible, values of the thing that you're buying. It's visible, so I think that makes a lot of sense. I mean, real estate has come into some difficult times, over the last handful of years, especially with commercial real estate, which used to be seen as kind of the bulwark of the real estate market, definitely fallen on the hard times during COVID. But that would still be my bet in terms of the first thing that you saw. Second thing I'd probably say is private credit, because I think you can already buy things like syndicated bank loans through a 401k plan. So there are some kind of inklings that's maybe the next shoe to drop. But I'm not a expert in this field in terms of what legislation is going to be approved and what the rules are going to be. So only time will tell.
Well, let's make an assumption, and then you can help me set up a rule, and then we can wrap it up.
Okay.
So here's the assumption. It's now available in 401ks. You can get access to private equity. What would be a good rule of thumb for how much exposure you should have to private equity within a 401k?
So I think a good rule of thumb for investors that have at least 5 years till they plan on pulling their assets out would be to cap your exposure less than 15% for sure. Most people less than 10%. There are definitely diversification benefits. As an employee that's had a 401k plan for a really long period of time, when I was watching my 401k plan through 2008, it was disheartening to see it decline by a large amount. So most of those private funds, whether it's private credit, private equity, real estate, would have all provided some diversification there. And, a 10% level is enough where you will see a meaningful change in the behavior of the portfolio, but it's not sufficient to, derail if you had to, let's just say, separate from a job or if you had to take an emergency withdrawal from your 401k plan, which, God forbid somebody has to do, but that does happen from time to time. You still have access to the majority of the funds. Likely, if you had a limitation in terms of how much you could take for an emergency distribution from a 401k plan, you're not going to have access to things that are private in nature, right? So that's probably a good rule of thumb to start with. And then the other thing I would think about is investing over time, dollar cost averaging into an asset class, especially one that you're less familiar with. So if your goal is to build a position, don't make that change or that shift over all at once, right? And the third thing I would say is don't be the first one in the door. Allow these things to kind of figure out, allow the logistics to play out. Give it a 6 months, maybe even a year or so before you actually act on the new thing that you see in your 401k plan.
So overcome the FOMO when it comes out.
Overcome the FOMO, yes. Overcome the FOMO. That's great. Robert, I know we're getting a little bit long on time here. This has been a lot of fun. Definitely a lot of things going on today in the world of finance, and the landscape continues to change. Thank you so much for giving us a little bit of an insight into how to navigate these situations. And if you guys want to take the conversation any deeper, come check us out at avidianwealth.com.